After studying this module, students will be able to know about foreign direct investment, learn about foreign institutional investment, understand the difference between FII and FDI, understand the impact of FDI and FII on the economy of India. We shall commence this module by studying about the foreign direct investment. Foreign investments are treasured by the developing countries for the simple fact that the multinational companies not only deploy capital but also technology, processes, knowledge, generate long-term employment, contributing in the economic development of their host countries, which otherwise could not be arranged as conveniently by these countries. Foreign investment refers to the flow of funds from one country to another country in return for the claim in form of the ownership stakes of the concerned companies or the assets of the companies. Generally, it involves the active participation of the foreign investors in managing the capital, physical or technical investment in the host country. Thereby, foreign investment is a broader term used for the different concepts like foreign direct investment and foreign institutional investment. The following chapter provides a descriptive account of FDI and FII. Foreign direct investment. FDI can be defined as the investment made by the entity residing in one country into an enterprise located in some foreign country. More specifically, it is designed as the investment of the foreign asset into domestic goods and services. Its characteristics are: FDI signifies a long-term relationship between the investor and the enterprise, which, unlike foreign institutional investment, does not flow out of the country as the first sign of the trouble in an economy. The FDI generally involves the acquisition of the management and voting rights with the level of ownership greater than or equal to 10% of ordinary shares, as the share ownership less than 10% is categorized as FII. FDI involves both initial and subsequent capital transaction between investors and affiliated enterprise. Classification of FDI. FDI is classified into inward and outward. FDI contingent on the direction of the flow of the money. Inward FDI, when the foreign assets are invested into domestic enterprise bringing the money into the base country, then it is called the inward FDI. Outward FDI, when the domestic assets are invested into the foreign enterprise taking the money out of the base country, then it is called outward FDI. These investments can be achieved by the variety of channels such as green or brownfield investment, merger or acquisition, joint ventures, franchising, which have been explained below. Joint venture. It is strategic alliance between two or more parties coming together to accomplish a joint specific task by pooling their resources and expertise. This task can be anything ranging from expansion of existing business activity to the new project. Example, a Japanese firm having the technology, process and expertise in the building of motorbikes entered into a joint venture with an Indian firm to establish a business in India. This JV assisted the foreign firm to grasp the rules and regulation, the legal, cultural and business environment and the respective market. This joint venture established the firm which came to be famously known as Hero Honda, a joint venture between the Honda headquartered in Japan and Hero headquartered in India. A JV can be spearheaded in the following manners: acquisition of some percentage of shares of a local company by the foreign investors, acquisition of some percentage of shares of the foreign company by the local firm, both foreign and the local entrepreneurs collaborating to establish a new venture or enterprise, both foreign and local entrepreneur collaborating to establish a new venture or collaborating to establish the new venture, enterprising along with the engagement of the public and or the bank debt. Merger and acquisition or cross-border acquisitions. Merger and acquisitions (M&A) are the method used in the consolidation of the companies. While the merger is a process where two or more companies combine to form a new company, acquisition is the process where one company is purchased by the another company without the formation of any new company. Both the structures result in consolidation of the companies both ways, economically as well as financially. The companies are motivated mostly by the following two reasons to undertake M&A, being M&A assists the company in filling the gaps through strategic alliance in their resources, offerings, processes, technologies or capabilities. M&A not only contributes in facilitating an entry into a new market with an established revenue stream, but also helps in addressing the issues of double taxation and profit margin by achieving economies of scale. Franchising. Franchising may be defined as a business arrangement where the firm grants the right or privilege to another entity to sell its trademarked product and service in a specific location for a fee. The fee structure comprises of two parts: an initial payment known as upfront fee or franchisee fee, and periodic royalty payment taken as a percentage of sales or a fixed payment depending upon the respective agreement. The popular example of franchisee agreement includes KFC, Pizza Hut, McDonald's among the restaurants like Marriott Hotels, Holiday Inn under lodging, Lakme Salon, Kaya, Habib's under salon segment, etc. Two types of franchisee arrangement exist. Direct unit or single unit franchisee is the most common and simple type of franchise where the right is granted to the franchisee to open and operate only a single franchise unit. Multi-unit franchise is the subsequent stage where on the successful operation of the single unit of the franchise, the franchisee can obtain the right to open more than one unit. This can be achieved by two routes. Area development franchise grants the permission to franchisee to open more than one unit within a specific period of time in a specific zone or a territory. Master franchise is an advanced form of franchising where the franchisor sells the right to the franchisee for not only opening and operating specified number of units in a specified zone during a specified period of time, but also requires the master franchisee to sell the franchises to other people in the zone expanding its business. The master franchisee is also entrusted with the task of providing training and support to the sub-franchises beside receiving the respective fee and royalty. Thus, its duties, tasks and benefits surpass that of the area development franchisee. Green and Brownfield investments. Greenfield investment is a form of direct investment where a new venture is established in a foreign country beginning from the scratch. That is, the new operational facility from the stores or for the factories are established by the parent company, while the MNC benefit from the access to the new unexplored market. The foreign country gains from the new employment opportunities created for its population, exposure to the new technology, expertise and know-how. Thus, in order to attract more such FDI, the host countries offer tax breaks, subsidies, special zones and other lucrative incentives to the parent companies. Brownfield investment is the form of direct investment where the companies do not prefer to start from the scratch in the foreign destination. Instead, the parent companies adopt an alternative route by purchasing or leasing the production facility that already exists in the host country to launch its own operation and production. In this manner, the parent company saves itself from the botherations of establishing a new infrastructure, accessing legal and environmental permissions, and make the required modification in the existing facilities, saving time, energy and resources. Licensing. In the simple terms, license means to give permission. Similarly, licensing may be defined as a written agreement between the two contracting parties where one party, who is the owner of the property, grants permission to the another party to use its property in exchange for the certain form of consideration. This property can be anything ranging from a certain activity to delicate information, process or technology secluded by patent, trademark or copyright. That is, it can be real, personal or intellectual. Motivation for FDI. Response to limited domestic growth. Either the intense competition or saturation in the domestic market restricts the growth in the home country. The firms thereby embark on FDI option, exploring new potential demand by penetrating foreign markets. For example, the Western automobile industry, with the saturation of domestic markets, is busy exploring Asian markets through various routes of FDI. Economies of scale. The desire to realize the benefits of the economies of scale and appreciate their bottom lines, profits. The firms enter new market where volume selling is possible, enabling the reduction of the fixed cost. For example, Walmart, one of the largest retail store worldwide, armed with the big size benefits from the economies of the scale through superior bargaining power with its supplier, direct purchasing, inexpensive distribution, etc., assisting in the lowering its cost, increasing its profit, and also appreciating its competitive advantages. Easy access to the foreign resources and knowledge. Establishing a subsidiary or joint venture facilitate the access to the knowledge of the foreign technology, resources, production process, and other managerial skills prevailing in the foreign organizations. This knowledge is then used to upgrade the practices in other affiliate enterprise subsidiary globally, whereas the resources save the transportation cost of the firms, lowering their production cost. By transferring or acquiring facilities in the countries where the core raw material are available, the companies are able to lower their cost and increase their profit. For example, China, Malaysia, Mexico and India serves as a new favorable destinations in attracting FDI from the foreign entities where cheap labor produces low cost and high quality goods and services for them. Repercussions of the trade barriers. The firm prefers establishing subsidiaries countries where their export volumes are high. However, the trade barriers in those countries serves as a roadblock that reduces the export volumes, impacting their business. Response to the appreciation in the foreign country's currency. The companies also establish subsidiaries in order to gain from the local currency appreciation in future in foreign currencies. Stages of penetration into foreign market. The first stage of penetration into foreign markets by MNCs has generally been observed to be an exporting stage, assuming the name of that MNC to be BRIO, having the business interest in 3 countries, India, China and Japan, where its products are exported in all these 3 nations. With the passage of time, the firm grows in the foreign market and gather the knowledge about the characteristics of those markets. Subsequently, the increase in the familiarity along with the growth of the parent firm BRIO in the foreign market paves the way for the stage 2 of setting sales and distribution affiliate. The decision of establishing sales and distribution affiliate in the foreign market properly analyzed response to the demand from the market in respective foreign countries. The company would not invest if the requirement is insufficient to justify the investment despite having export market phase 1 in those foreign countries. Hence, sales and distribution affiliate is established in 2 markets of China and Japan only. Next, the parent firm BRIO proceed to stage 3 of entering into licensing agreement with the local foreign country firm PST. Only in the case requirement exists in that country, which turn out to be only in India. Armed with proper capacity, managerial and technical knowledge, the foreign firm PST obtains the license from the parent firm to distribute and produce the product in India. Though BRIO must have been attracted by the relative benefit of the higher profit vis-a-vis negligible investment required in the licensing agreement compared to that in FDI, the demerit in the form of the limited control on its quality standards lead to stage 4. Henceforth, the post cancelling the licensing of the foreign firm PST in India, BRIO decides upon the acquisition of that firm and establishing its personal wholly owned subsidiary, that is opting the FDI route. Numerous reasons could have been motivated such decisions. of heavy direct investment in the foreign country on the part of Brio. Such a decline in sales, appreciation in defects in the product, thereby customer complaints or desire to expand its operation and thus market in the country by offering superior quality products or even the tax breaks and other incentives offered by India. Therefore, in essence, this theory suggests that the expansion into the foreign operation is a gradual process whose first step begins from the exporting, and it is not necessary for all the parent firms having operations in different countries to rigorously follow these stages from beginning to end. Different stages transpire in different countries for the same parent firm, which is basically a response to the demand to the respective markets in the foreign countries, and also post considering the political situation of the respective host country. The exporting fundamentally provides an opportunity to the parent firm to acquire all knowledge about the market, competition and the nation cost effectively before embarking upon an unfamiliar territory and setting up the business there. Exporting facilitates the chances of the parent company to survive, succeed and realize the complete benefit from its high risk investment. Product cycle theory. The product life cycle states that FDI is a stage in the life cycle of a new product launched in an oligopolistic market that exploits the product and the factor market imperfections. This theory was proposed by the Raymond Vernon. We shall now understand foreign institutional investment. FII is defined as the investment made into the share of a firm by the foreign investors having no interest in the management of that firm. It involves the transaction in highly liquid securities and other financial assets of the firm. It is in complete contrast to the foreign direct investment, which provides the investors with the managerial control over the company, while FII investor has no controlling say in the management of the company. It involves the purchase of the shares in one or more foreign companies, generally by the insurance or the pension fund houses, without gain of controlling stakes in those companies. The equity investors holding less than 10% of the ordinary share of the companies are classified as foreign institutional investors. These transactions are also referred as portfolio flows. The investors in this case earns from the interest payment or in the form of non-voting dividends. Recently, SEBI created a new class of foreign investors in India known by the name of foreign portfolio investors, FPIs, being a fused product of numerous classes of existing investors engaged in the portfolio investment in India. The foreign institutional investor, qualified institutional investors and sub-account of FIIs were fused to form FPI, with the aim of simplifying the investment experience of the foreign portfolio investors, which earlier had to adhere to different respective guidelines prior to making investment in India. Now, all these investors only have to observe the guidelines issued by SEBI under FPI regulations by notification dated 7th January 2014. Moving further, let us now learn about the difference between FII and FDI. Though the root of both kinds of investment is same, being the investment in the foreign country, there exists a difference between the two. Definition: FDI is the investment made by the parent company in the company of the some foreign country, whereas FII, it is an investment made by the investor in the market of the foreign country. Investments made into The investment made into FDI involves the purchase of the stock of the foreign company to secure a controlling interest in that company. It also includes the acquisition of the non-financial assets, example, technology and intellectual capital. Whereas investment made into FII involves the purchase of the shares in one or more foreign companies, generally by the insurance or the pension fund houses, without gain of controlling stake in those companies. Management. In FDI, in this kind of the investment, the parent company invests to take a direct control of the foreign company. The objective is to assume the managerial position in the foreign company, managing their operations in the foreign land, forming them their subsidiary. I repeat, whereas in FII, the managerial responsibilities are left in the hands of the managing board of the companies only. The investors, FII, insurance or pension funds in this case, are concerned only with the returns on their investments without any intervention in the passively holding their securities. Earnings. Under FDI, the earnings of the FDI occur in many forms involving dividend, royalties and direct earnings from the subsidiaries, whereas the dividend earned from their investment in the stock or interest on the bonds of the foreign company form the major source of earning for FIIs. Liquidity. FDI offers lesser liquidity to its holders owing to its nature of investment in the fixed assets, which makes difficult to sell. Nevertheless, it offers a stable earning option, whereas in FII, these form a highly liquid investment asset where their sale and trade is quite easy and convenient, and it is because of its high liquidity that leads to the investment are more volatile. Strategy. Long-term strategy is adopted by the investors in FDI, whereas FII functions on the short-term perspective. Merits of FDI is the economy benefits from the increase in the production, technology and management transfers, employable skills, employment opportunities, revenue receipts, standard of living and balance of payment, whereas the benefits attached with FII inflow is relatively lower in this case. FII increases only the width and the depth of the stock exchanges, resulting in the better prices discoveries processes for the scrips. Let us now discuss the impact of FDI and FII on the economy of India. Foreign investment is considered to be an important driver of the economic growth, particularly for developing economies, as it forms the part of the investable sources, facilitating capital to the host country. The impact of the economy can be summarized separately for FDI and FII. Impact of FDI on the economy of India. The advantages are as follows. The poverty in the host country witnesses a decline with the increase in the growth and per capita income. The receipt for the host country increases through the increase in its tax revenue. The host country experiences a rich exposure to the developed skills owing to the transfer of both technology and management from the foreign company. The labor forces enjoyed an improved level of wages and salaries. This results in the increasing the standard of living within the economy. The economy also benefits from the surging access to the export markets. There is an overall development in the economy with the local producers increasing their production in response to the additional demand from the host companies. Both the balance of payment and the capital accounts witnesses an improvement. Impact of FII on the economy of India. With the investment focused on the capital market, the FII alleviates the liquidity of the domestic capital market. For instance, the liquidity of the Indian capital market has witnessed a substantial appreciation in the capital market post the adoption of the liberalization policy of 1991 that opened the gates for FIIs. It increases the depth and the breadth of the markets, financing wider range of the investments. With the more player accessing the markets, the liquidity of instruments being traded in these markets increases. Every player experiences a greater role with the savers investors finding additional opportunities to invest and earn, while borrowers finding more and cheaper avenues to borrow to finance their expansion or start up new ventures. The corporate sector witnesses an increase in the adoption and implementation of corporate governance practice. In order to having an edge in accessing the capital markets economically and efficiently, the companies improve their compliance of CG accounting standards, and transparency beside their performance to better attract the investors in the market. The domestic capital market, with the involvement of the foreign investors, get exposed to more sophisticated technologies and tools, assisting in refined analysis techniques and the better management of portfolios. The FIIs assist in promoting the development of the domestic equity markets along with the encouragement to the shareholder activism, which in turn nurtures the superior corporate governance practices in the firm. In essence, FII brings the discipline and know-how to the domestic capital markets, strengthen the markets, develop functioning of both markets and the corporates, and incentivizes the higher disclosure and transparency, thereby better CG practices in corporates. Consequently, the resources and the capital is allocated properly, leading to the development in the economy. Let us now recapitulate what we have learned so far. FDI can be defined as the investment made by the entity residing in one country into an enterprise located in some other foreign country. Joint venture. It is a strategic alliance between two or more parties coming together to accomplish joint specific tasks by pooling their resources and expertise. Foreign institutional investment is defined as an investment made into the shares of the firm by the foreign investors having no interest in the management of that firm. Foreign investment is considered to be an important driver of the economic growth, particularly for the developing economies, as it forms the part of the investable resources facilitating capital to the host country.